Hey, I need you to put the phone down for 60 seconds and listen up. This is the real talk. We're all trying to get ahead, buy that first home, pay off the student loans, and actually retire one day. But there is a massive structural earthquake happening on the other side of the world, and it is about to hit your bank account and your dream of financial independence. I'm talking about a financial breakdown in Japan that will send US mortgage rates spiking higher, make your car loans and debt more expensive, and seriously rattle your entire retirement portfolio. If you're like me, you probably think, what does Japan have to do with my budget? The answer is everything. We are looking at the forced end of a $20 trillion financial trick, a mechanism that has propped up the US market for decades, and its collapse threatens to pull our markets down hard. My name is Liam James, and I am not here to scare you, but to prepare you. Stick with me, because by the end of this video, I'm going to show you exactly why this crisis is personal and the 3 simple, immediate moves you must make today to shield your future. To get this, we have to talk about Japan's debt. It is absolutely insane. Their debt to GDP is 234%. Look, the US is around 120%. Japan is literally carrying double the burden. Think of it like this. If you make $50,000 a year, this is the equivalent of trying to manage $117,000 in high-interest debt. It's mathematically unsustainable. How did they pull this off for 30 years? It's the greatest financial cheat code ever written, thanks to the Bank of Japan. For decades, the BOJ just printed yen and bought all their own government's debt. That kept their interest rates at zero, basically free money. This free money was the engine for a global financial strategy so huge, you've probably benefited from it without knowing it.
So, what changed now? Well, the game is up. 2 things broke the Bank of Japan's control in late November 2025. First, the government spent too much. The cabinet just approved a massive 21.3 trillion yen stimulus. That's over $135 billion in new spending. It's like throwing gasoline on hidden fire. The market saw this and went, nope, we don't believe your zero-rate policy anymore. Japanese bond yields instantly jumped to levels not seen in 20 years. They lost control. Second, inflation is crushing people. Japan was supposed to be immune to inflation, but it's back and it's ugly. Inflation is running above target, and the real killer is the human cost. Wages for the average person have fallen for 9 straight months. Your food is more expensive, but your paycheck is smaller. When the average person is hurting this badly, the central bank has to act. They are totally cornered.
Here is the key to why this is your problem. It's all about the yen carry trade. Here's the simplified version of the $20 trillion trick. Step 1. Big investor borrows 1 billion yen for virtually free in Japan. Step 2. They immediately turn MAT into our US dollars. Step 3. They buy US assets like our safe, high-yielding treasury bonds. They collect that 4 to 5% return risk-free. This massive flood of cheap Japanese money helped keep US interest rates low for years and fueled the massive stock market and real estate gains everyone enjoyed. But when Japanese interest rates have to rise even a little bit, the profits on this trade disappear. When the central bank meets on December 18th and 19th, they are expected to be forced to raise rates. That small move is a guaranteed signal for those investors to sell their US bonds, take the money, and rush it back to Japan. The trade unwinds. When that $20 trillion trade unwinds, it's not just a slow withdrawal, it's a tsunami hitting the US bond market. Japan is our largest foreign creditor. They own $1.2 trillion of our debt. The sale. They are selling that debt off in huge blocks. When everyone sells US bonds, the price of those bonds drops. The rate spike. This is the physics of finance. When the price of a bond drops, the interest rate or yield must rise. That US government rate is the foundation for every loan in the country. This means your 30-year mortgage rates, they are going higher.
Your car and student loans, they're about to get more expensive. Your credit card rates, they're climbing up fast. This is the brutal, direct consequence for young adults carrying debt. On top of that, this instability will cause the kind of volatility in the S&P 500 and the NASDAQ that will make your 401k feel like a roller coaster.
Look, in chaos, there is always opportunity. You just have to know where to look. Here is my strategic blueprint for positioning your portfolio for the inflation and instability coming our way. Sectors to favor, the safe bets. 1. Energy and materials. When the dollar is devalued, real things, oil, gas, copper, gold, are where value goes. They are classic inflation hedges. 2. Tech with pricing power. In a high inflation world, companies that can raise prices without losing customers are king. I'm talking about businesses with true monopolies or powerful, indispensable brands. Quality over quantity. Sectors to avoid, the risky ones. 1. Companies with high debt. Rising rates are debt poison. Any company that has to borrow a lot of money just to keep the lights on is going to get absolutely crushed by higher interest payments. 2. Financial institutions, banks. They have heavy exposure to the exact currency and hedging messes caused by the carry trade unwinding. This is not the time to be in the banking sector. 3. Discretionary consumer stocks. When consumer debt gets expensive, people stop buying non-essential stuff. Don't bet on companies that rely on consumers having extra cash.
We've covered the threat. Now, here is the immediate, non-negotiable plan you need to execute. Do this before the end of the year. 1. Get non-dollar exposure. If 100% of your net worth is in the US dollar, you are taking a risk. This doesn't mean crypto. It means holding physical gold or silver or getting exposure to global commodity markets. 2. Kill variable rate debt. Seriously, go through your loans. If the rate can float up, you need to either pay it down aggressively or lock in a fixed rate right now. This is a guaranteed future saving. 3. Go on a balance sheet deep dive. For every company you own, check its cash reserves and its total debt load. If the debt is high, it's time to sell and rotate into stronger, cash-rich businesses. You are now informed. You have the knowledge to protect your house payment, your student loans, and your future. Now you need to create the plan. Let me know in the comments if you've already started preparing. Thanks for watching.